don't get into debt. But then when it comes to going out there and buying our first home, and now we have to go shop around for a home loan, we don't know what to do. Today, we are going to be breaking down how a mortgage loan works and how you can prepare yourself to go shop around and also get approved. So, if you're a first time home buyer or you are looking to become a real estate investor and you've never purchased a home, this episode is for you.
Today, we're going to talk about how to pre qualify you if you are a W 2 employee or a self employee. But first, what is even a mortgage? A mortgage is a loan from a bank or a lender that lets you buy a property without paying for it all at once. You put usually a down payment, they fund the rest, and you pay them back over time. The basic components of a mortgage are PITI, principal, interest, taxes, and insurance. Principal is the amount that you borrow. Interest is the cost of borrowing that money. Taxes often collected by the state. And insurance also collected by your escrow company. In some occasions, you will have mortgage insurance that comes in when you put less than 20% down, and it varies by loan program. How the loan gets approved? Lenders look at a set of criteria that includes your income, your credit, how much debt do you have in your finances, how many assets you have, and the property itself that you're acquiring. They're basically asking one thing: can this person afford this loan? And will they pay us back over the time of the loan?
When I had to look for one, I didn't even know like where to start, what kind of loans are out there because there's several loans that once you start shopping around, you're going to come across, and some of them have some benefits that might apply to you because depending on your circumstance, there's different loan options available for you. So I want to talk about four main ones that you might see or might be available to you. Conventional loans is a mortgage that's offered by a private lender, which typically is always people go to their bank or their credit union. But there's also like brokers and stuff that you can go and they'll shop around for private lenders to offer a conventional loan. This one is not insured or guaranteed by the government like some of the other ones that we are going to talk about. But the conventional loan is popular because you can use this one for either your primary home or as an investment property. But depending on how you use it, it's going to determine like how much you need for a down payment. So for example, if it was your primary residence, then you can go as little as, a down payment of 3%. Now, of course, other criteria comes into that when that lender decides how much they want to require for a down payment. You will be required to have a private mortgage insurance known as PMI if you put less than 20% down in a conventional loan. And then for an investment property, you're not going to really find a lender that's going to accept less than 20%. But the good thing about conventional loans, again, one, it could be used for primary residence, your primary home, or for an investment property where you don't have to live in it. And they have pretty lower interest rates. They're less strict on the condition of the property. Now, you can't go like full rehab, like full gut job. But with some of these other loans, they require that the property is in livable condition. But with a conventional loan, you could get away with a little bit of a property that needs a little bit more work, which is great if you're looking to kind of like do a live and flip or things like that. The next one is the FHA loan. And it's basically a mortgage that is insured from the Federal Housing Administration. So that means that this loan is backed by the government and is typically for not so great of a credit score. Maybe their income isn't that high, but because it is backed by the government, you're going to get lenders, private lenders that are okay with accepting that risk and being more lenient of the requirements. So it's great for first time home buyers, and you can put a down payment as low as 3.5%. But With this one, it does have to be your primary home. So you have to live in it, but it's still a good option because you can still find a home that can be a rental property and live in it for a year, fix it up or whatever, and then, turn it into a rental or sell it if you manage to have some forced appreciation on that. But the good thing is that you can also get multi-families up to, I believe, 4 units. The next one is the VA home loan. This is the one that I use. Now, this is available only to people that have had military service or a spouse of a military member. So veterans, active duty military members, they have access to this loan. And it's kind of similar to FHA where it's backed by the government, but this one is backed by the US Department of Veterans Affairs. And again, same private lenders are more lenient with the requirements and the down payments because the government's going to back up this loan. The great news about this one is that you're not required to have a PMI if you put less than 20%. You also don't need a down payment. So when I went to buy my first home and I used this, I didn't put down a down payment. I only covered like the closing costs, which was very low, and I didn't have to pay PMI, so that was nice. And I got a pretty decent interest rate because they have some competitive interest rates. You do have to live in the property for at least a year, unless you get like deployed or sent somewhere else, like the military moves you. Again, you could buy multifamily homes up to 4 units, but still you have to live in 1 unit. One of the drawbacks is that it does have to be, livable. So you can't really get a really beat up property. And you have some other restrictions that you have to pass through and extra things like have a termite inspection and things like that. And then the last one I want to talk about is the USDA loan. And this is another government backed loan, but this one is backed by the US Department of Agriculture. And this is for low to moderate income home buyers that are in rural areas or certain suburban areas. The good thing about this is like if you want to live in like a rural area and you qualify based on like the income and stuff, you have access to this loan, which doesn't require a down payment as well. You have competitive interest rates. And although you still have to pay a PMI, the rates are going to be lower. Again, the drawbacks is that you do have to live in it and you can only qualify if depending where the property is located. So you have to go look and see where you can go look and shop around for a property. And again, you have to meet the income limits because it is geared towards helping the lower to moderate income first time home buyers.
I also want to mention that when I purchased my first home, I didn't know about all of these options that we had: USDA loan, NACA loans, conventional, FHA. And I was just listening to the broker that I was referred to, and he was basically guiding me through the whole process. But I wish I had an episode like this, which I would have been benefiting from because it was really nerve wracking to go through your first transaction, and everything feels so final that knowing a little bit more would have eased out my doubts. But moving on, how to get approved step by step. Check your credit. So, most of the loan products that you're going to try to get, either if it's a BA, USDA, conventional, FHA, they're going to require you to have a good credit score. Mostly for FHA, they want 580 or higher, which, if you look at it, that's not a very high credit score they're requiring you to have. But for conventional, they do want to see 620 and higher. And the higher your credit score is, the more likely you're going to have a lower interest rate. Number two, they will ask you to organize your finances. So you will need to have proof of down payment money in any of the accounts that you have. If you have a retirement account and that's where you keep your down payment, they will need to know that you will be able to access the money quickly. You also have to have enough money to cover your closing costs, which, if you would be able to see, a general rule is 3 to 5% of the loan. Some banks will require you to have 3 to 6 months of mortgage payments in your savings account, so you have that available. Your debt to income ratio, so DTI. This is a concept that a lot of people don't get, including me for the longest times. Your debt to income ratio is calculated by how much money you bring in yearly, monthly. So your gross income minus your debts, and that will be calculated on a monthly basis too. For most programs, they want you to be at below 43% debt to income ratio. What does that mean? That means if you, for simple math, you make $60,000 a year, so that would be about $5,000 a month, they will calculate that 43% of that. Step number four would be if you are thinking that you are financially stable to go ahead and start investing, you should get pre approved. People have fears about getting their credit score dinged. But if you are ready to take step number one, which is like purchasing, sending offers, you need a pre approved letter regardless. So you would need to get pre approved. And the points, most lenders do a soft, which will only cost you a few points. And then you have a window of 21 days or 30 days to see how many more pulls you have. They still know that that pull was originally to look at mortgage loans. What documents do you need as a W 2? If you're a W 2, you need at least the last 30 days of your pay stubs. As far as your tax returns, you need the last 2 years of your W-2s and your tax returns. The last 2 to 3 months of your bank statements, a copy of your ID, and proof of any other income. That includes bonuses, child support, military, VHA, etc. If you're a self-employed, it becomes a little bit more tricky. You still do need your last 2 years of personal tax returns and your last 2 years of your business tax returns. Your year-to-date profit and loss statement, a balance sheet, business license, bank statements for personal and business accounts, as well as any other 1099 forms. If you write off a lot of expenses, remember, you may pay less in taxes, but lower your qualified income. And I think that's one of the barriers that we keep running into when we're self employed because your income appears on paper lower than it is. So you would qualify for a lower even mortgage payment. What happens after pre approval? So you got your pre approval letter, you're ready to find a property, you find a realtor that you like, and they submit an offer, and that offer gets approved. What comes after? So you enter escrow. Normal and escrows are 30 days, and normal escrows will require you to do an inspection of the house. So that would be most of the first 7 days that you have from getting your offer approved. Then after that, you would probably would submit your earnest money, so that would be the money that you have to open the contract of escrow. Usually is it depends on its amount agreed upon, goes into an escrow company, a title company, and they hold it until the transaction is closed. After inspection, appraisal comes. Whoever is lending you the money, a bank, a credit union, FHA, Fannie Mae, they will submit an appraiser to make sure that the home that you're purchasing, it is actually valued at the price that you're purchasing. So the lender confirms that this home is worth the price. Then all of this inspection appraisal goes into underwriting from the bank. The lender, it's like their financial detective to verify every document that have you submitted for your pre-approval. And finally, when underwriting is done, you get a date to close. This is the ya casi moment. Once you get a closing date, you will most likely can close in person, which means you're going to be having an appointment with a notary and you're going to be there for like an hour signing 1,000 documents. But you sign, you get your keys, and you're officially a homeowner and our investor.
Sounds all, like complicated and like a long process. Again, it takes about 30 to 45 days to go through the closing process after you already like found your property and submitted your offer and it got accepted and got into contract. But I want to share kind of some tips, get a good realtor and a good lender because especially as a first time buyer, you really need those people to guide you through that process. And you want to make sure that they are willing to take that time to educate you and not rush you through this whole process, because this is a big deal. This is a big purchase. It's a lot of money, and there's a lot of things that you have to make sure that are in the contract to make sure that you don't get screwed over. Which brings me to the next tip, is that make sure that when you go into contract that you protect yourself, do your like inspections, make sure that those things are in the contract that you're able to get out from the contract. So for example, you go look at a property and then you do your property inspection, and there's things that are like uh, really big deal breakers for you, then you have the ability to back out of that contract. Otherwise, you may lose your earnest money. If your financing falls through, that you have something in the contract saying that, hey, if my falls through, then I'm able to back out and so far. So, like, that's things that you'll talk to with your realtor and stuff, that you want to make sure that you protect yourself so that way you're able to get out of that contract if you need to. The other thing is that even though you might get a pre-approved for a certain amount, that doesn't mean that that's what you can afford. Because as Lindsay was going down the list, they're only going to look at certain things when they are pre-approving you. So they're going to look at your income and just some of the expenses. Like obviously they're going to, like, if you have student loans, if you have a car loan, things like that, very obvious things, they're going to take that into account. But they're not taking into account, like, for example, how much gas you spend, how much groceries you spend per month, if you have childcare, things, dog food, things like that. All those add up and is going to determine how much you can actually afford as a mortgage. So, for example, like when we're looking for a house in California, I got pre-approved for way a lot. But I ended up going about half of what I was pre-approved for, because I knew that realistically I would be more comfortable at a lower priced home. And because you have things like maintenance, which is another tip, is you have to take that into account, that you are going to have maintenance for the house, repairs, painting, updates, just, decorating, furniture shopping, all that stuff. And so you want to have extra that cushion to be able to afford those things. And with the reserves that Lindsay mentioned, is you want to have, the typical one was like 2 to 6 months, but now with like layoffs and everything, like you might need to go a little bit like up to a year. And then as far as for repairs, they say like 1% to 3% of the home values is what you should be aiming for. I would probably go towards the higher end because everything's so much expensive now. And the other thing is shopping lenders. They should be competing for your business and not trying to push you to, because they get commission and all that. A good lender's going to want to build a relationship with you and educate you. You are the customer, you are the client. They should be the ones that are, working to bring you on and have you as a client.
Everything is mostly negotiable. I had realtors in which I negotiated their commission down on the loan estimates that you get. The first box that you have are the loan costs. So the loan costs are things like broker's fee, origination fee, underwriting, document fee. Sometimes they have a filing fee, especially if you're doing this for an investment. So you do want your closing costs to be competitive. And then, like I mentioned, your closing costs can be 3 to 5% of the loan cost. So if you're getting a loan for 100K, $3,000 to $5,000 is what you're expecting to be your closing costs. And this is what I'm mentioning when it's at your origination fee, broker's fee, underwriting fee. Those are your original loan costs. You could ask your lender, hey, person A is charging me only $500 for underwriting. Person B is charging me $1,000 and you're charging me $1,500. Can you match that person A's estimate? And that is when you bring in the negotiation point. And it is a business and it is looking at all components. But as a real estate investor, you definitely want the least amount out of pocket to go into a deal so you can maximize the profit.
Yeah, the mortgage process can be intimidating. especially in our community because we usually don't have someone that has gone through the process. So I know I was the first one that went through the official process. Surprisingly, like, my parents, they went through like creative financing basically because it was owner to owner. But a lot of us, we had to figure out this whole process. So that's why, we wanted to create this guide. But yeah, if this episode helped you out, share it with somebody else, another first gen that's out there getting ready to buy their first home or their first property. And don't forget to like and subscribe. And if you are someone that is interested in you know going out there and buying your first rental property, whether you want to house hack it or live and flip or whatever, check out my free 5-day crash course. That's going to be linked in the description. But other than that, let us know any questions that you may have. We're always available via our socials. DM us questions. We might use it for an episode. We'll see you in the next one. Bye.
Bye, guys.